Hey guys, welcome back to another episode of the Wealth Circuit Investing Hour. And tonight we have none other than my friend Ryne Williams. Ryne is on the program tonight, and we're going to have a good time. We're going to talk about, I think, some really good questions that you guys sent in the Discord. If you're not a member of the Discord, it's linked in the notes to this video. And so you gave some great questions out there. I will say that I have, I think it's allergies. I feel fine, but my voice is pretty much gone most of the time. And I may cough a little bit, but if I do, I'll try to hit that mute button. And if I get in too much of a coughing fit, Ryne, you have to take over, my friend.
Well, the cigarettes haven't been helping, Kevin. I've told you need to cut back on those.
That's true. I gotta back away from those cigarettes. But and then the other thing is the little housekeeping item is that I will actually be on vacation the next 2 Monday nights. So I will try to put together some edited videos that I'll set to show during those times. But we're going to be going into Wyoming and South Dakota, looking at things like the Grand Tetons and Mount Rushmore and that kind of stuff. So it should be a really fun trip. And so I'll take some video, maybe show you guys. I mean, there's nothing more exciting than seeing somebody else's vacation pictures, right? So, so I'll do that. So with that, let's go ahead and get started. And Ryne, the first thing I want to ask you is, you're fresh off of the marriage train, and how are things going with that? How's life as a newly married couple going?
Yeah, like I was saying earlier, it is it's more or less the same as before, which is a good thing. My now wife, we've been together for 5 years, just over 5 years that we were dating. And out of those 5 years, we've lived together 4 of those years.
Oh, wow.
So for quite some time now, we've already felt like an old married couple. And so I guess it's good to make it official, but it's been great. Yeah. We had a lot of fun at the wedding. We just got married here in Las Vegas. So we had a Vegas wedding, and had all our friends and family here in town for a few days. And it was perfect. I don't think we could have asked for anything better. So it was a really fun time.
That is so cool, man. Well, congratulations.
Thank you.
I don't think I've had a chance to tell you that, but that's really awesome. So now you have
Thank you. I really appreciate that.
One more piece of paper than you had before. So
exactly. Can never have too many of those.
That's right. That's right. So, but tonight, what we're going to do is we're going to hit some of these questions. And I think what we'll do maybe first is kind of give some shout outs to see who all's here. And so let me do that real quick. I've got to back up to the beginning here. So we got Nathan Robert, who is in the house, and Shaping is here. Shaping is really excited about this live stream tonight. Our buddy Pat is on the line. He says we're 2 of his favorite people. He must not know many people. So we appreciate that, Pat.
You're the man, Pat.
Michael Swami's in the house. Great to see you. And John Jay says, talking about one of the things Russ. Pat said was that Russ, if Russ was here, and absolutely, I mean, Russ is just a top-notch guy, and I love having him on. And so we might have to do the trifecta at some point.
There are so many good people in the dividend investing community. We really have a great group of people here.
Exactly. Excuse me, I forgot the mute button that time. All right, so with knowledge of utilities, let me come back to this one if I could. That's might take me a minute. I am very familiar with Exelon, so let me come back to that. Don't let me forget, John Jay, if I forget. So what's the best way to stay updated on dividend cuts? That's a great question. To stay tight with the news, I guess, right? What would you say, Ryne?
I would say so. As it pertains to your own holdings, I think we'll talk about this probably more in the video, but there are some warning signs you can look out for. I'm sure we'll get into those a little bit later, but yeah, if it's an important one, if it's one in your portfolio, you'll find out about it one way or another for sure.
Yeah, that's right. So Greg's in the house. Way to be there, Greg. El Dynamico, our friend from West Sacramento, is in the house.
Yes, sir.
So it's great to see you here, my friend. Kevin Mendoza. Antonio, yeah, absolutely. Kevin Mendoza is in the house. That means there are 2 Kevins in here now. So we have a quorum and we can go ahead and get started. Suzuki Man's here. Jim Betts is here. Jim's been putting together a lot of cool stuff, man. He's got this Facebook page that he uses to track stocks and some research and stuff like that. So it's pretty cool stuff. So El Dynamico says we are the dynamic duo. I'm just not sure which one of us is which. So
you're Batman, Kevin. You're definitely Batman.
I don't know, man. So we got Clayton Maherg is in the house. Michael Swami, honeybees are better. I don't know better than what, but they do have some. I've got 3 hives now, man. And Kenji is here. Let's see. We got Miguel Fernandez is in the house. I know Michael Ferguson. That's why I went there. So what does John Jay say? John Jay say, oh, not new wife, but your hair got a little lighter.
Might just be the lighting.
Must be the sun.
Yeah.
All that sun you've been getting.
Been out in the sun for sure.
One question that our mutual friend, ex-dividend dad, asked is, about
the mullet.
Yeah, when are you going to grow a mullet?
I've already started, man. Just we'll circle back on it in a handful of months. But yeah, it's back. It's back there. It's coming along nicely.
That sounds good. Let's see. All right. Well, let's go ahead. I think we got Tutomi here. Oh, and our buddy Russ. Our buddy Russ is here.
There he is.
I didn't get the memo that it was Blue Shirt Day. I only have black. That is true. We did plan this. So we plan to have similar shirts on. This is the uniform for the program tonight. So no, actually not. It was just an accident. So, but with that, let's go. We'll hit this back again, and maybe we could just dive into a few questions if you're ready for that. You got 100%. Got your skis on. You ready to do some skiing?
Just missing my helmet, but let's do it.
All right, let me get this thing set up here. I'm gonna get rid of Russ, and we may have to do it like this.
That's cool.
All right. And so anyway, here's the all right, this is gonna be really small, guys. I don't know if I can make this much. Let me just try this. Does that help?
That's a little better.
Yeah. So I'll read it just so that you guys can hear the question. The question comes from Shaping, and it really is in the area of an investor mindset when stock prices decline. And his question goes something like this: as dividend investors, I know we are supposed to be happy about dips because that means we get a higher yield. However, but at the same time, it still sucks to see the unrealized losses. What is a good mindset to have? So how would you respond to that, Ryne?
I think just in general, you want to be as optimistic as you can, and you want to have faith in the companies you own. But I think the best place to start when you see, especially a big share price decline in a short amount of time, like for example, maybe what we saw with Starbucks recently is a good example. Mm-hmm. I think the best place to start is to try and identify why that happened. Why is the share price going down? What's causing that? Is it something related to the company specifically, or is it something maybe more macroeconomic related that is impacting not only that company, but others as well? And there may be a combination of the two as well. But either way, I think you want to identify why what's going on is going on, and think about whether that changes your long-term opinion of the company. Whatever it's going through right now, is that going to be detrimental 5 years from now? Is that going to be a problem 10 years from now? Because you want to think long-term with all of these. A lot of stuff is going to happen in the short term, but I think as the long-term thesis is still intact, then, sometimes you just have to plug your nose and hang on tight.
Mm. Yeah, sometimes it gets a little stinky. So, yeah, I think that's right on. That's exactly the way I would do it. Couple of examples for me. One, I'll use one of my two bad examples, and then I will use a good example. of exactly what Ryne was talking about, and that is I am a shareholder in let me use Stanley Black & Decker, and I'm also a shareholder in Air Products, and they both have seen dramatic declines, right? Stanley Black & Decker was like up in the high 100s, maybe low 200s, and that was when I was buying into it. It's been a rough go, but as they declined, I continued to average down because I believed in the brands, I believed in the management team, and we're seeing that no matter how good the management team is, when the demand is not there, it is hard for them to make money. So I'm in a place with Stanley Black & Decker where it's now in the high 80s, right? So now I averaged down along the way, so I think I'm down only maybe in the like 45% range, but that's still a pretty big number. So I think from that perspective, I should have been more patient, right? So what did I learn from that? One of the things that I like to do is think about what I should learn, because everything is going to be different every time we do it, right? So we want to learn principles, and maybe the principle that I should have used more on Stanley Black & Decker is patience and not been so quick to average down. But then, the other example is Air Products, right? It took a big hit, and I invested some in I don't remember, the 270, 275 range. It got up almost to 300, and then it dropped dramatically down to around 214, I think is what it got down to. And so I ended up buying some more shares at 219. I bought some a couple of weeks ago, 3 weeks ago, at about 228. It is, and so I got my average down below 240, just below 240, like 239.50 or whatever. And so now it's back in the 240s. And so I'm actually up on Air Products. And but I was patient, right? I didn't just go right in and start buying shares. I was patient with it, and reaffirmed what I believe the investment thesis is for the company, that long-term view that Ryne was talking about. So those are maybe a couple of examples, I think, from my portfolio. So I don't know, maybe the investor mindset is just to be patient, right? You've done your due diligence, you know what you expect from the company. If it doesn't pan out and it's not what you thought, get out, right? But if it's still there, just be patient. So
one thing that I found really helpful, and I just started doing this maybe within the last 6 months or 8 months or so, is actually writing some of these thoughts down when researching new companies, especially ones that you're pretty serious about. Write down some of the things that you like about them, some of the things you don't like about them. Write down what their competitive advantages are. Write down what the risks are. And that's always something you can refer back to in times like this. When there are turbulent times, you can look back at that and remember what it was about this company when you first bought into it or when you were first researching it. And that can help maybe remind you why you bought into it in the first place. And if those things still hold true, then maybe that brings you some solace in the face of the share price heading south.
Yeah. Well, Ryne, it might be a great opportunity if you wanted to chat just a little bit about this new tool that you have on your website. I think you call it the Investor's Almanac, right?
Yeah. Let me see if I can share my screen real quick, because I think that would definitely help paint a better picture. I got to pull it up here.
I think I've got it set where you can share as well.
Okay. But as I'm looking for that, so essentially my Investor's Almanac is kind of like what I was just describing a moment ago. For me, it's kind of like I refer to it as my second brain for investing. And let me share my screen real quick. I won't ramble on too much about this at all, but or for too long, I mean. But this is what it looks like. Can you guys see that? Are we looking good there? Yeah.
Yeah.
Okay. So this is what it looks like. And let me hide this. But basically, there's a few different things here. This is where I do all my stock research. This is where I do all my book notes. And it's been really helpful, like I said, when researching stocks, I can just go in here and log all these different these different aspects of the companies I'm researching. So what we're looking at here is Visa, for example. I've got a full written history of the company that I wrote down and pulled together from podcasts and articles and videos. And I just kind of took some notes and expanded on it in here. A background of the company, how they make their money, some industry info that maybe talks about some of their competitors. I go through the financials, management and capital allocation. I could probably do a better job with this. I would say this is probably one of my personal shortcomings when it comes to researching companies, but also competitive advantages as well as risks and valuation. And then once I go through all these different things and take notes on it, I have this other section down here that's reflections. And it's kind of like tying all of the research portion together. And it's just a few different questions. Like in a few sentences, explain the company like you were talking to a 9-year-old. If you can explain it simplistically, you probably have a good understanding of the company. You can probably wrap your head around it pretty well. Why shouldn't you invest in this company? Give one good reason that you shouldn't invest in it. What could kill this company? If the stock market closed for 5 years, would you still feel comfortable owning it? Yes, no, why? And then some other quick questions right there. That's pretty much what I've been using to do stock research. And there's also a section in here for quarterly earnings notes, annual reports notes, just other random news that happens. But this all goes down in my Investor's Almanac. And over time, I want to use this to go through all the companies in my portfolio, any future companies I'm researching. And at least so far, I've gone through that process with a couple companies here, Shutterstock and Visa, and it's been really helpful. It's really helped me have a step-by-step process for stock research, but also it helps me go a bit deeper when I am doing the stock research. So instead of keeping all this stuff in my head and sometimes it goes in one ear and out the other, I now have a dedicated place to log all this stuff that I can refer back to. And I found that in times like this, it'd be really helpful to look back on all these notes. So that's essentially my Investor's Almanac. There's a bit more to it. You can also do book notes, other journaling stuff in here. I'll go through this real quick. So like book notes, for example, a few that I've read: Onward by Howard Schultz, Same as Ever, Morgan Housel, Investing for Growth by Terry Smith. I got all my favorite quotes in here that I've broken down. And then there's a journal section in here as well. And one thing that I've been doing is I've been going through all the Berkshire Hathaway annual shareholder letters, and I've gone through a small handful here. But then, for example, same thing as the book notes, I'll just go through the memorable quotes, put them down in here, and then maybe expand on them a little bit more. And so for me, it's been really helpful for the overall learning process as an investor. So in the pursuit of knowledge and wisdom, it's been really helpful. So at some point soon, I want to roll this Investor's Almanac out. I've been kind of slacking, just kind of been busy with life and work stuff lately. But now that that's kind of calmed down, I'm going to start the process of rolling this out and hopefully getting this out to you guys here pretty soon. So that's it. Sorry for the spiel.
No, that's really cool because I think it's really important for us to document what our thoughts are because, and I don't know if you're like this, Ryne, but the older I get, the less I remember things. So, when I actually go through and document something and come back to it later, I go, oh yeah, I remember that now. But, I might not be able to keep it all in my head at the same time. So having that structured approach and, on your website, I think that's a really cool idea. So I'm glad you put that together. I really appreciate you doing that. I think it'll be a good tool for people.
Thank you. I'll have to send you a copy of it so you can check it out. I'd love to get your feedback on it.
Okay. Yeah. Love to do that. Yeah. Always love to review things. All right. So let's go back to the next question here. And the next one has to do with, and since I made this bigger, I'll have to do this. Battling emotions in a volatile market. I mean, that's, I think, all of us deal with that, I think. And if not, then, we need to probably get you tested because, it's an emotional thing when you've got money invested, money that you have worked hard to earn, and you've invested that in the market, and you look up and the market is down 10% or 20%. So 10% of that money's gone, 20% of that money's gone. It's an emotional thing. So Mr. Income, also known as Fender 53, I don't see him in the program tonight, but he asked this question. now that the market is being unforgiving to quality companies' stocks that falter, how to react rationally. The usual errors we all commit from time to time: panic selling. Make sure that I get all of that. Yeah, panic selling, temporary problems, panic averaging down, like this is the last day to buy discounted shares before it spikes back up 20% tomorrow, ignoring appropriate portfolio applications due to fear of missing out, into the can't miss deal. So I think the point of this question is, we were really trained, maybe even from like 2013 forward, to that the market was going up at such a clip. It was really easy to be an investor because no matter what you bought, at some point that's going up, and it was going up pretty quickly. And if the market did have a small dip, you jumped in and you bought the dip because you knew it was going up really, really quickly. Since 2020, it's been a little different market, right? We had a bear market there for a while, and so it's really become more of a market where we need to be more, investors rather than, stock pickers, right? So, what Mr. Income's asking here is, how do you battle the emotions of all of that when you see your stock really plummet and you're afraid that it's going to go back up and you're going to miss out on that gain? So, how do you handle your emotions when you're thinking about that, Ryne?
Man, I think part of it kind of goes back to what you were saying a few minutes ago in terms of being patient, especially that part, panic averaging down, like this is the last day to buy. I think being patient has a lot to do with it, especially when you just always have to keep the long-term in mind. You're going to be doing this. If you buy a company, I mean, if you're my age, you're going to be doing this for at least another probably 60, 70 years. Hopefully you got another 60, 70 years left in you. So you have a long time. and also to your point, at the end of the day, it's not picking stocks. We're not necessarily buying these things just to see them go up. I mean, we do want that to happen, but at the very root of it, what's more important is buying good businesses. And I think when you think about it that way, it's maybe some of the panic goes away because the business is still going to be there. You're still going to have an opportunity to buy it. It's still going to be there. So there's not as much of a rush. And I don't know, battling the emotions though in an overall volatile market is a really difficult thing to do. And that's something I think I've been kind of battling with lately myself. I feel like things are really, at least this year, things have been really all over the place. Since November, we've seen in not a long period of time, we've seen a lot of very quick ups and downs. So it's kind of hard to, and I know you can't predict what's going to happen next, but it is kind of hard to gauge what's going to happen tomorrow. And it does make it hard to make decisions. But I think just in closing, I think you do have to go back to just trying to buy good businesses. And I don't know. It's probably not the best answer, but that's all I got for now.
No,
I'll keep spinning my wheels, but
no, I think that's pretty solid, man. Because buying good businesses is good for the long term, right? And so if we really keep that long-term vision that you were talking about, the long-term perspective, then it is emotional when the stock market goes down. But if we bought great companies and we know what valuation we want to have on those companies, and we're able to pick up shares of that company, even if it continues to go down, as long as it's below what we believe it's worth, then go ahead and keep investing in it, because that's what investing is about. It's about buying quality companies for quality prices. And I don't know if that's the right way to say that. Quality companies for below valued prices. And, eventually, these companies are going to continue to grow and end up in a place. And, Ryne, your thought about 50 or 60 years from now is solid, because, if you were to, well, maybe I can do that. Well, if we were to look at a chart of, let's say, Johnson & Johnson, and we looked back 20 years ago, we would love to buy Johnson & Johnson at the prices of 20 years ago, right?
Sure.
It's just going to continue, hopefully, to go upward as the quality business that Ryne talked about, as that continues to grow, then the share price is going to grow. So, having a little bit extra trajectory in their thought process sometimes helps with the emotions. I think dividends help as well, at least for me, when I know that, because I'm not in it to get really the capital gains, but I want capital gains. And so I know that, what I really want out of today is the dividend, and I want the capital gains for the future. So that kind of helps me a little bit. But, I think Ryne also mentioned patience, and that's, I think that's from my perspective. I think we're pretty similar there.
I think too, some of these too, I think you have to be okay with letting some of these companies pass you by, because things are so volatile right now. Yeah, we've seen some quick drops, but we've also seen some really just insane climbs. And when you see that stuff, it's easy to have this FOMO and feel like you're missing out. And so you go on the hunt for whatever is going to be that next thing, or even chase the current thing after it's already run up. And that's just that's one of those emotions you'll have to fight against. And I think you're right too, Kevin, that dividends do help with that, because at the end of the day, the main objective is to build your stream of passive income. And as long as you're doing that, I think you're taking steps in the right direction. And that definitely requires more patience than other types of investing, I suppose. But in closing with all of this, I think, to put it simply, and when battling your emotions, just focus on these three things. This is from Terry Smith, who wrote that Investing for Growth book that we saw a few moments ago. But his whole thing is like a 3-step system. It's buy good companies, don't overpay, and do nothing. So, wow. And that's what Charlie Munger would call sit on your butt investing. He used a different word, but it'll be nice here.
That's great. Yeah, I appreciate you sharing that, because that's solid advice. Yeah.
And if it ever gets to be too much, just turn off the TV for a little while, get out of Seeking Alpha, and go to the mall or something. Go get a smoothie, go live life. And, you know, if you own good companies, they'll still be there when you get back, and they'll hopefully still be providing you with that sweet, sweet cash flow. So can't complain too much.
You can go grow some chickens, or,
or some bees or something.
Yeah, absolutely. Okay. All right. You ready for the next one?
Mm-hmm.
The next one is, how should investors respond when a company radically reduces its dividend? And Samurai's in 1980 says, I saw Dapper Dividends, that's our buddy Russ, owns a stock called Leggett & Platt or something, and it dropped its dividend and is losing value. I think it was said on his last video, I was just thinking, I wonder what Kevin would do if this happened, and ever wondered what I would do in that situation. I thought that would be an interesting discussion. I think it is an interesting discussion, Samurai's. And just coming from memory, I'm not an investor in Leggett & Platt, but I think they reduced their dividend by like 89%, right? Mm-hmm. And that's a pretty big decrease, man. So, how do you think, Ryne, how should we respond to that? What's our approach when that happens? Because we had Intel do that as well, right?
I was going to bring that up. I've been on the receiving end of 2 different dividend cuts. Intel was one of them. WP Carey was another one, and I think they were both for kind of different reasons. And I will say, a dividend cut, although it's not good for investors, it's like the worst thing that could happen to a dividend investor. It's typically it's a good move for the company, typically. Mm-hmm. And so if you believe in the long-term fundamentals of the business, and you think it's going to be a good long-term investment, then I think that maybe you should welcome dividend cuts, even though in the short term it's going to result in less income for you today. It's probably typically a good thing for the company from a long-term perspective. And so if you're buying the company because it's a good company, then it's something that you should maybe be a bit more objective about, instead of having like a knee-jerk sale reaction just because, dividend cuts aren't good. But still, it stings. It's not an easy thing to go through. And I will say, in the case of Intel, it actually ended up being a really good thing. I think they took their dividend yield down from like a 4% something to like a low 1%, if I remember correctly. But after that, the share price ended up shooting up quite a bit and going on a really nice run. So as someone who was looking to exit that position, it ended up being a good thing. And then WP Carries, I feel like came out of nowhere, and it wasn't because the dividend they weren't able to cover the dividend. It was otherwise a very safe dividend, but they spun off some of their portfolio. Then at that point, they weren't able to afford it anymore, which is probably no surprise. And so it was a necessary move. But sometimes that's just how it goes. But I don't know. I'll probably keep spinning my wheels if I keep talking. So I'll let you jump in here, Kevin.
Yeah, I think that's right on, though. I mean, I guess the way I look at it is the dividend process to me is part of the company's capital allocation process. So they can do, one of several things with their capital. So at the end of the day, they sell their product for a price. They have costs of creating that. And so they make earnings, and those earnings translate into the balance sheet and into cash flows. And so if they have extra cash flow, what do they do with that? What they do is they can buy back shares, they can pay dividends, they can invest in their property, plant, and equipment. They can give, they can pay down debt. That's another one they can do. There's probably a couple of other small things that I'm not thinking about. So they've got a lot of decisions to make around where their excess capital is. But so the question is, what happens when they don't have excess capital? And, I think it really depends on what's going on with the company. So, for instance, Leggett & Platt, I don't own them, and I have not done very much research. I did look at them a couple of years ago because they had a relatively high yield, and I thought, wow, that might be good for my after-tax account because, I'm looking for higher yield stocks. But there was something about it that, it just did not look right to me. So I ended up not buying into that. But the thing I would look at, how I would respond when a company announces a dividend cut, is whether I believe that dividend cut is important to get the company back on track again. So is management making a decision that is unpopular in a move that is brilliant and bringing the company and making it better in the future? And so that's kind of the way I would look at it. I love to get dividends, but at the end of the day, I want my companies to do well, because if they don't, then they don't pay any dividends, right? So I guess I would have to look at, why is it happening? What decision are they making? And are they doing it to keep the company solvent, or are they doing it to grow the company in the future? If they're only doing it to keep it solvent, I'm out, I'm moving on. But if they're doing it to grow the company in the future, I think I might stick around. So, and I will say this, and I don't know if a lot of investors recognize this or not, especially newer investors. Most of the time, we as investors cannot catch big moves in the stock price, because most of the time they happen off hours. Because, most of the time, any big news by law is supposed to happen outside of market trading. They have to get special clearance if they're going to make an announcement that's of any materiality inside market hours.
And that's why you see companies reporting their earnings before the market opens or after it closes.
Exactly. And so because of that, the market price is going to move off hours, and so it's going to open different than it closed. And so we're going to miss that move, whether it's up or down. So we have to be ready for it. And so if a company radically reduces their dividend, the stock price is going to go way down. We're not going to catch that anyway. So we've already lost that capital. So the question is it worth staying, or should I move on to something different? And I think that's the approach I would take.
Yeah. And I think part of it, I mean, sometimes dividend cuts do come out of nowhere, but there are times as well where it does seem like the writing's on the wall. And I've got to say, I feel like that was the case with Leggett and Platt for a while. I'm not going to get all the stats correct, but from my recollection, even if you just look at the income statement over the last decade, their gross margins were declining. Their operating margin was declining. Their net income margin was declining to the point where it was officially negative. So they had a negative payout ratio. They were paying out more in dividends than they were generating in net income. And I think the free cash flow payout ratio was a bit kind of on the fringe too. I don't quite remember. But those are some warning signs to look out for. And I would say in general, I think this is why too, it's for, especially for new investors, one of the best places to start is to start learning how, especially if you're coming into this with no prior experience, one of the best places to start is to try to learn how to read financial statements. It's not always easy. It's not always interesting, but it's a really important skill to have if you're going to be looking at individual companies, because you'll be able to see some of these warning signs, like a couple of the ones that I just described. And common sense will tell you if the margins are going down, if they're not keeping as much money at the end of the day, there's no way they're going to be able to maintain that dividend over a long period of time. And I think Russ commented this earlier in the stream a few minutes ago, but if it happens one quarter, where the earnings are negative or the free cash flow is negative, that's okay. That's something to look out for. But if that becomes a consistent trend, that's a really big red flag that can indicate that a dividend cut may be around the corner. So these are just some of the things you have to look out for.
Yeah, I think maybe to sum all of that up is that we can't always just look at the numbers. We have to look at the why behind the numbers. And
true.
That's, that's served, I think all of us as investors served us well. It's always good to ask why. Why are they doing that? So anything else on that, Ryan? If not, we'll go back and pick up John Jay's question on Exelon. I promised we would do that.
Let's do it.
So let me do this. I haven't looked at Exelon in a while, so let me share.
I actually don't think I've ever looked at this company.
Okay. Well, Exelon is a utility. It's based really out of Chicago, but its footprint. It stretches from Chicago all the way to almost to the East Coast. But not like solid. It's not contiguous. It's got different utilities through there. So let me share the right screen here. Okay. Oh yeah, we're familiar with Seeking Alpha, but real quick, let's go to let's go to my favorite one, which is it's not because it's really my favorite, but because it really shows everything on one screen. But you can see the dividend yield, just for everybody's benefit. The dividend yield for Exelon is 4.05%. It's got a pretty decent dividend growth. Dividend safety is 80. They had a struggle, I guess, back in 21. They, their dividend could have been in a little bit of danger at that time. Payout ratio is around the 60% range. Latest dividend is moving pretty fast, but the last 5 years is 1%. They have decreased their dividend back in 13 and 14. I do know this. I do know that Exelon had some issues with its regulators, and it was really around some inappropriate activity by the management team. That's been probably about 3 or 4 years ago. I have not kept up with it to know, how they've resolved that. But it sounds like their dividend is pretty safe. But I would say this: I think Exelon is a normal utility. I don't think you get anything with Exelon you don't get with Southern Company that you don't get with Duke. I think it's a pretty run-of-the-mill utility. My favorite utilities, John, are NextEra, Pinnacle West out of Arizona, and WEC out of Wisconsin. And so why are they my favorite? They are my favorite because Florida and Arizona have the fastest growing populations. So they are getting load growth just by the fact people are moving into the territory. And Wisconsin has a lot of investment in as does NextEra in renewables. So those are some of the growth aspects of those utilities that I think will serve well in the future. Plus, I mean, we're down, the interest rates are high, and as interest rates come down, I think the utilities will benefit a little bit from that. So any thoughts
with utilities,
on that?
Well, I don't really know much about utilities. I have Southern Company, but it's always been a sector that I'm a bit fuzzy on. But so based on what you were saying, one of the main things you want to look for with a utility that could indicate maybe more, maybe faster growth is just population trends. So if they're moving into the area, they'll get more customers that way. And so that's probably more meaningful than like rate increases, because those are regulated, right?
Yeah, exactly.
Okay.
So one of the ways to look at it is the way a utility makes money is to invest money. So that's why it's really difficult. Let me show you guys this. This will be fun in a nerdy sort of way. Let's look at its see the free cash flow payout ratio being negative. A utility by design will always invest more cash than it brings in. And that is because as it invests money and puts those assets into service, the rate structure picks up and pays the company back for those assets that are depreciated over some, let's say an average of 40 years. So they will get that money back over time, but their growth happens in two ways. One is it will happen by increasing their assets that are invested. So they're growing their asset base, is what it's called. They can also grow their earnings through a rate of return, so through a rate case. And then thirdly, they can grow it by growing their population, right? So if they have more people using their product, it grows. If they have a higher rate of return, it grows. And if they have a higher investment level, it grows. Does that make sense?
Yeah. So maybe a good metric, like a good quick hand metric to look at when trying to gauge how fast they're growing is maybe like return on assets. Would that be the most appropriate for utilities?
I think that would work well. Yeah, I think that might work well because they're going to be growing. They're going to be paid for the assets that are on their books, right? And if they have, here's a way to think about it. So that might be a great metric. I had to think through, because that would also include intangible assets and stuff like that, which aren't in the rate base. But I'd have to think through that a little bit. But so they, as they spend money and they put more assets on the ground, those assets get, they're paid for those assets. Not only do they get paid for the depreciation on those assets, but they get paid the rate of return for the investment. So it's a regulated rate of return. So if, let's say the rate of return is 10%, let's say they have $1 million invested in property, plant, and equipment, they're going to get $100,000 in profit plus whatever depreciation happens, right? They call it a return of and a return on, right? That property. So that property happens, but if there's more people moving into the area, the rates will be based on how many people used to be in the area, right? So they're able to actually make more money because they have a higher growth rate. Now, all of that kind of works its way out in the long run, but that's just the way their business model works. So it's always good to find utilities whose rate base is growing and whose population is growing.
Okay, that's good to know.
So the rate base can be, renewables, right? There's a lot of renewables that are going on right now. So that could be the rate base. But if their population's growing, that's even better. And they'll call that organic growth a lot of times.
Michael says return on invested capital is the best measure of utility returns because net income is skewed by depreciation. Okay.
Yeah, exactly. And that Michael is big in the utility industry as well. So I didn't see his comment there, but yeah, that is exactly right.
Okay, yeah, that makes sense.
Michael is like big time down in the Texas ERCOT area.
That's good to know.
Yeah.
Thanks, Michael.
Yeah, thanks for popping in there, Michael. That must be way down here because I'm still looking for it. But oh, there it is. Yeah, it's way down there. I must be way behind.
I know how that goes.
So John, Exelon is a fine company. It's got great metrics, but it's no different, I don't think, than what you would find with other utilities in the area. If you're looking for a utility, it's a fine utility. I just think there are better ones out there, I guess is the way to say that. Okay, so let me come back to So this is a good question, also from John Jay. And let me take this off the screen here. There we go. So John Jay's asking, high interest rates are good for BDCs and low interest rates are good for REITs. I would agree with that. I think BDCs, very similar to banks, make more money when they have higher interest rates. And REITs, as well as utilities, they make more money when they have lower interest rates. That's the way I look at it.
A lot of business development companies have primarily floating rate loans, which will go up or down with interest rates in the same direction. So as interest rates go up, they're able to generate more interest income from the loans they have out. And with REITs, lower interest rates just means it's cheaper to borrow money. So it's easier for them to profit on their deals.
Yeah. And when interest rates are moving up like they did, you want to find REITs who have a lot of fixed rate loans, right? But when interest rates are coming down, you want them to have variable rate loans so that you can, get a better earnings. So
I don't know that I've looked at too many REITs that have a high percentage of variable rate loans. I feel like a lot of the main ones have primarily fixed rate from what I've seen.
Yeah, I think that's right. And that would be the smart thing to do in this time. But, when the interest rates begin to come down, they're going to either need some variability in their rates, in their rate of return, or they're going to need to be able to refinance to get lower rates. One of the two. Okay, Jim Betts wants to know about Stinky Tyson. Dropped over 5% today. And I looked at that a little bit. I don't own Tyson, but I did look at that a little bit. And Tyson, their forecast didn't look very good. And I think that's, a reasonable thing because, and I think they're being real when they say that. They just are seeing, the future not being as bright as it was. And I heard some folks say that they have a great position in the protein area, especially chicken. And so that, they're not going to be down forever. But the question is, where do you get in? And it's a little too volatile for me at this point. Any thoughts?
Like Tyson's had kind of they've had an interesting couple of years. I feel like they've really gone up and down and up and down. They're actually up 15% in the last year, which is interesting.
Let's take a look at.
But that share price chart has been a roller coaster.
Let me do this. We'll add this to the stage here. So this is fast graphs. Let me back this down to maybe 10 years or something. No, let's go 13 years. So this black line is let me take some of this off. No, I'm going to leave it. The black line, you can see it's like way up, way down. It's pretty volatile, very cyclical, it looks like. But look at these earnings. These earnings dropped a lot in 23. And I think you're seeing the reaction to that. The earnings are projected to go higher, and so the stock has moved a little bit higher. But I still think it's a little overvalued according to what the charts are showing here on fast graphs.
I haven't kept up with it enough to know why there's been such a big earnings drop. And when was that? That was at the end of 2022 or going into 2023 that it dropped so much. I wonder what caused that.
Yeah, I don't remember. but I want to say it was. I don't know. I know they had an issue, not earnings related, but they had an issue with their leadership. I think their CFO. I think he's got the last name of Tyson, who actually ended up in somebody else's house, sleeping in their bed because he was drunk, didn't know where he was. So, that doesn't give me a lot of confidence in the management team either. So,
sure,
there's that as well.
So I think I'm looking back at the news. So about February of 2023, their profits just plummeted. So that's about there. There was an avian flu outbreak in November of 2022. But it's kind of interesting. I mean, going back to November of 2022, they were projecting really strong profitability, but then it just went south kind of out of nowhere. So I don't know. I'm not seeing any specific news on it.
Yeah, I think, I don't know. I'd have to look it up as well. I just don't remember. I used to own it way back in here. Oh, wait, sorry, I'm on the wrong screen. Way back in here. But I sold that off somewhere in here.
Okay.
And fortunately, I did that. I'm not, I'm not prescient. I didn't know the future, but they just put together a strategy session, like an all day thing. Maybe it's a half day thing. And I, hit the highlights of that. And I just was not impressed with their long-term strategy. I just didn't think it made sense for the industry they were in. And lo and behold, it just started coming down. So sometimes a saying that I heard from somebody in North Carolina is, some days you're the bug and some days you're the windshield, right?
Yeah. That's true in life. That's true in life as well.
So that time I happened to be the windshield, but that didn't always work out that way.
So Kevin, what do you think about what's going on with a lot of these restaurant stocks right now? I mean, Starbucks is obviously one of them. McDonald's is kind of maybe like shared a similar sentiment as Starbucks. Even Yum Brands, which owns restaurants like KFC, Taco Bell, Habit, they're even reporting negative comp sales in their latest quarterly earnings report too. I mean, do you think we're gonna? I know you can't predict the future. Do you think this is maybe indicative of things really starting to come to the surface as far as what's going on in the economy and potential talks of a recession goes? Do you think these are just some of the early signals we're seeing of that?
I think so. I mean, there's a thing in economics called elasticity of demand, and I think what we're seeing is, and just as an example, my wife and I went to lunch yesterday with some friends of ours, and it was basically a chicken place. I think, my wife got some grilled chicken, and I had some fried chicken, obviously, but the bill without the tip for 2 lunches that were basically chicken was $38 in Alabama, right? So it's pretty high. The prices are getting pretty high. So these restaurants, and I'm not saying that they're gouging people, I'm saying that their costs are going up pretty fast. And I don't know that the people, the consumer, is going to be able to keep up with that rate of increase that we're seeing. So I think the restaurants will struggle over time. And I think we're seeing a couple of different things at Starbucks, but that's one of them, is this inelasticity of demand, right? Where, you can't pass on every cost increase because people they'll have some kind of substitute, or they will just not go out to eat, and they'll have some other approach. So I think the restaurant business in general is going to struggle until we can figure out this idea of inflation, or even stagflation, if that were to hit.
And that's when inflation stays high, but then there's a recession. Is that right?
Mm-hmm. Yeah. Okay. So think about it this way. I started to draw some charts just in case this came up, but in economics, if you've been in economics class, you'll know that there's a supply curve that goes this way and a demand curve that goes this way. And the price is where those lines intersect, right? And so the idea is that if you're going to, I'll use my hands. So if you're going to reduce demand, then the idea is that the supply would stay the same, but demand would move down the supply curve, and therefore prices would come down. And so what happens in stagflation is the demand does reduce, but your supply curve shifts because there's either, poor economic policies, financial policies from the government, or regulatory things that are just onerous, right? And so the supply actually comes down as well, but the curve shifts, right? And so there's less demand and there's less supply. So you're in a recession because the supply is down, demand's down, but the prices stay the same because they're on the same spot on the chart. Yeah. So that is stagflation.
Man, it's just going to be really interesting to see what these next, really what the rest of the year brings, but really these next couple of years. It seems like a lot of this has kind of been building up over these last, maybe really since COVID. And maybe we just didn't notice it because there was so much money being pumped in and being printed and pumped in that we were able to spend. And so maybe now that that's tapped out, maybe you can't kick the can down the road any longer. I don't know. This is my first time really experiencing a lot of this stuff. So at least since I've kind of been tuned into it. And so it's just been really interesting to see and think about.
Yeah, and I think that's why we're seeing some of these this sticky inflation, right? What they call sticky inflation is that the supply curve is moving as well, because it is very clear to me that demand is reducing, right? Demand is declining, but the prices aren't moving that fast, and so I think we're seeing some supply move as well.
I wonder if they'll end up having to raise interest rates even more from here to really nip inflation in the bud. It would make what we're seeing worse for sure, but I can't help but wonder if that's going to be pain in the short term is going to be best for the long term. I don't know.
Yeah, I think it's certainly an option. I don't know that Powell has the appetite to do that, because at some point you reduce demand to a level where there's a lot of job loss.
Sure.
And so that's the thing he's looking at is inflation and jobs, right? Employment or unemployment. And so if you get to the place where you've reduced demand so much that your unemployment is way high, that's not a good place to be either. And so I think he's trying to balance that. I saw something today that said, the economy is not going to have this soft landing that we all had hoped at some point.
And if that ends up being the case, I think, we'll probably see share prices go even lower than where a lot of them have gone today. So for us dividend investors, there may be some good buying opportunities up ahead. Absolutely. Although they may not look like it because we'll be knee deep in the middle of maybe some tough economic times, kind of like what these restaurants are going through right now. And that might be a bit more amplified. So it might be tough to buy, but then again, this is where it goes back to thinking long-term and managing your emotions and remembering your long-term thesis. Those might be where the opportunity lies. And when it comes to being patient, that's when patience will pay off. So interesting times ahead. That's for sure.
It is, no doubt. That's why they call it investing, right? Otherwise, if it was easy in the long run, anybody could do it, right? So it's
the hardest part is the emotional part and managing yourself.
Yeah. Well, managing me for sure. Let's see. I'm going to move on down because I just looked down at the clock and we're at 59 minutes now.
Oh, yeah, we are.
Yeah. So this has been cool, man. I've loved having you on.
Well, thank you for having me on this. Yeah. I'll do this anytime. Anytime you want to do this. It's always great chat. And I always say this, but every time we talk or every time I watch something from you or read something from you, I always learn something new. So
that's awesome.
It's not only is it enjoyable, but it's informative as well. So I love it.
Well, and I've told you this before as well, but one of the things that I really love about your channel and about all that you're doing is just seeing the growth in you over the last, 3 years that we've kind of been in touch with each other, and I mean, you have grown so much, and you're such a valuable resource to this community. So I appreciate you.
Well, thanks, Kevin. I've had a lot of really smart people helping me out and holding my hand, you being one of them. And like I said at the start of this, we have just a really solid community of people who all want to do that. We're all just here to help each other learn and get better. And it's just a really special community to be a part of. And so I'm fortunate to be a small part of it.
Yeah, same here. So ex-dividend dad wants to know if we did this dress thing on purpose.
Yeah. Well, originally we were thinking about doing shirts versus skins, but I decided I probably should put a shirt on. I saw Kevin wearing blue, so went and grabbed mine.
Yeah, that's right. Let's see. Let me just pause. Let me hide that. Let me hit down here, and we'll. I'll see if there's anything that's like really cool that we should expand on. Yeah. So John says, saw your NE looks a lot better than Exelon as of now. Yeah, I would agree with that. I think that's right.
For a utility company, NextEra seems to have some really solid dividend growth.
Yeah, they do. And, the challenge there is going to be their renewables and whether they're going to be able to invest enough long term. And but I don't think that's a very big risk. The Wisconsin company, the risk there is they got some underground gas lines in Chicago. That scares me a little bit because the city of Chicago has said they're not going to replace those. And who's going to be holding the bag if something happens, if there's an explosion? It'll be the utility. So that scares me a little bit.
Yeah, I mean, we've had some pretty good examples over these last handful of years of how detrimental those freak things can be for utility companies. Like, think Hawaiian Electric, think PG&E. It can be pretty bad and can take a long time for those to recover. Yeah.
Okay. Let me. You see anything, Ryan, that you want to hit on?
I don't think so. I think we covered some really solid ground. I see a lot of talk about fast food and prices, and the grandson of Tyson, who was talking about the guy who ended up in the wrong person's bed.
Yeah.
So otherwise, I think we're pretty well caught up.
Good.
Suzuki Man thanks us for calling him smart. You're welcome.
Oh yeah,
you are one smart cookie, Suzuki Man. You are one smart cookie.
Absolutely.
Mr.
Well, man,
Watsko.
it has been so good to have you on. I'm really glad you joined, and so I'll be out of town the next 2 weeks, but we'll look to have you on sometime soon and
Absolutely.
do this again because I love talking about like these strategic kind of questions a lot more than I do about specific companies, because some of them I know and some of them I don't. Right?
Sure. Yeah, it definitely makes you think. And like I said earlier, one of the hardest parts about investing is managing yourself and your own emotions. But I think it's once you can kind of think about some of these questions, it helps you do so, and that's a really good skill to have. So definitely makes me think too. So yeah, I like it.
Awesome. Well, Ryan, I appreciate you being on, and as you heard on your live stream the other night, I didn't catch your live stream live, but I did watch it afterwards. And we do have a closing song, so
I heard about that.
So I'll kick us out, and then when I end the stream, I'll bring you back. How's that sound?
All right, sounds good.
All right, I'll see you in a minute. Hey, thanks everybody for joining. It's been a great time, and I will see you again in 3 weeks. So have a great time.